On May the 2nd, Warren Buffett's conglomerate Berkshire Hathaway reported a net loss of $50 billion after a pandemic swiped the world, which tells us that even the greatest minds in the world of finance aren't insured against unexpected events. Even though the company managed to report a profitable quarter recently, its stock price hasn't even regained itself back to pre-pandemic levels. Buffett lost his position as the third richest man in the world. Even people like Elon Musk, who seemed quite far away from Buffett's level, have exceeded him. No matter how smart, talented, or hardworking are you, the market is unpredictable. And if you're not careful, you might end up losing everything while thinking that you stumbled on a golden opportunity that will make you a millionaire. While there are endless kinds of mistakes investors usually make, especially beginners, there are 5 fundamental mistakes that even mature and experienced investors make and end up losing a fortune. If you don't want to be one of them, if you want your investment to keep growing, if you want to build a fortune in the stock market, then you have to avoid these fundamental mistakes. So, listen carefully. Confusing investing with trading. Beginners who just start investing imagine that you have to find new cool stocks to invest every day or every week. And if you have spent the entire month not investing in a single company, then you're not an investor. In the world of the stock market, there are investors and there are traders. A trader is someone who buys a stock with intentions to sell it on the same day or in the next few days, because the goal isn't to invest, but rather buy the stock and profit from the volatility of the market. Have you ever seen how fast stock prices move? They jump up and down every single minute, if not second. The price opens at $100, for example, and closes at $105. So if you trade with $100,000, you can expect to make a $5,000 profit within the day. In theory, it seems like an easy way to make money, but it's much more difficult in practice. Stock prices are almost impossible to predict in the short run. And as a trader, it doesn't matter what stocks you are buying, even if these companies are complete trash, because you're not looking to keep your money there. And that's what makes it so different from investing. Investing means buying tiny pieces of businesses that produce something meaningful and grow over time. So does the value of your investment. So if there is one company you know that's doing great, you know what is it going to be 5 or 10 years from now, you might keep investing in that company instead of reading endless financial reports and waste your time analyzing unlimited financial statements. Number 2. Investing emotionally. Whenever a certain asset is rising dramatically, you have tons of people suddenly get interested in investing, although they didn't give a damn about it before. Remember what happened with Bitcoin just a few years ago? The price rose so dramatically that people who had no idea what cryptocurrencies are, who didn't understand how blockchain works or the technology behind it, suddenly started buying Bitcoins, hoping that they are going to make a fortune. I'm not saying anything negative about Bitcoin, blockchain, or cryptocurrencies, but investing based on your emotions is a bad idea. Usually it turns out to be disastrous. Bitcoin is just one example. Remember the mortgage crisis? Even the most qualified investors could not resist and jumped in. However, the entire thing collapsed and some countries are still suffering the consequences of that crisis. In the late 1990s, even a giant tech company such as Yahoo made a horrible decision investing a few $billions in Broadcast.com, which 2 years later they had to shut it down. But Mark Cuban, who was smart enough to sell his entire stake before everything collapsed. Here is the rule of thumb: if it's already in the news and rising dramatically, you missed the opportunity. Accept it and don't feel bad about yourself. By the time you get in, the cycle might be at its peak. Any investment you make should be based on rational, calculated risk. Yes, of course, you might end up missing some great opportunities, but you will avoid the risk of losing all of your wealth and build sustainable portfolio over time. World's greatest investor, Warren Buffett, missed the opportunity to invest in Google, Amazon, and a lot of other great companies. There are two types of stocks worth buying: a stock of a company that has a promising future and its current stock price does actually represent its value today and not 5 or 10 years from now. And secondly, a stock that's for one reason or another is undervalued. Everything else does not worth your money. Number 3. Waiting too long to start. Investing is all about time. The earlier you invest, the more you're going to earn. $100 invested when you're 20 will turn to $466 by the time you get 40, while the exact same $100 invested when you're 30 will turn to just $215 by the time you reach 40. That's assuming if you invested in an index fund with annual rate of return of 8%. I know that you might be thinking that, let me wait until I figure everything out. But that time will never happen. There will always be something you don't know. It might sound a bit controversial because just a moment ago I warned you not to invest if you don't understand what you're doing. That's true, but you don't have to be a financial genius to start. If you're not much into the stock market, invest with an index fund. Start with a fraction of your savings or monthly paycheck and then give yourself some time to learn. And once you educate yourself, you can go ahead and invest in companies you believe are going to do better than the S&P 500 in general. I know that you might not have the time, but you don't need to spend hours and hours looking for companies every day. You have to do it once or twice a month. And once you find a good investment, just keep investing there. My biggest position is in an ETF. I also invest in individual companies, but I'm very careful with that because I don't want to spend a ton of my time every day to track these stocks. Number 4. Not being able to look outside the stock market. Real estate and the stock market are the coolest investments, but they're not necessarily the best. My best investment that I have ever made were all in businesses that I started. The stock market is more to keep my money growing while I'm busy growing my businesses. Because if I keep them in a saving account, inflation would eat them out. So I invest in stable companies that have some room for growth. Maximum what you can expect from the market is 7 or 8 or at best 10%. Of course, it's different every single year because there were times when S&P 500 was higher by 20% or more, but other times it was down by a negative percentage. But when it comes to small investment in small businesses that seems to be working, returns can be a few 100% if not thousands. You have the ability and the power to influence it. While when it comes to these multi-billion-dollar corporations, you can't do anything. So don't be blinded by the stock market. The best investment specifically for you might be under your nose. And finally, investing what you can't afford. It's easy to get excited about investing. I get it. You see all these numbers, you want to jump in and nail it so that your bank account gets filled with these green papers. Or to be more precise, with those numbers. And that was the case with me as well. But you have to consider other factors as well before you throw your money in. If you need that money in the next few months or so to cover your basic expenses, then it doesn't worth it to invest. Here is why. Since the market is unpredictable, even if it's a huge and stable company in the long run, it will probably grow. But in the short run, the stock price might fall. And if you suddenly need money to cover your basic expenses, you might end up selling your investment at a loss. So don't get overexcited. Of course, start as early as possible, but be rational about the amount you want to invest. It's better to start with something small but consistent, even if that means just a few $100 a month. If you have started investing recently or you're interested, please take these mistakes into account. I don't have any other interest other than helping you by sharing my experience with you. It's just so painful to lose the money you worked so hard to earn in a blink of an eye. I'm not saying that you will never lose anything, because that's a fundamental part of the game, but minimizing losses and mistakes is a crucial part of success in anything, including the stock market. And now, it's time to smash that like button if you have enjoyed this video and found it helpful, most importantly. And if you're new around here, make sure to subscribe and turn on your notifications. Thanks for watching, and until next time.